Hello, welcome to a new video. Today we'll be doing another tier list, but today we'll only be looking at growth stocks. So let's jump straight into number one, which is Celsius Holdings. Now Celsius has an amazing growth story. However, in their latest quarter, the revenues actually fell by close to 30%. And that was a very big drop for a growth stock to actually take on. That is why the stock price actually went from around 90 to 25, and why I'm actually going to classify this stock as a C. Now this is because to me a very important point that a growth stock should have is predictability of its revenues. Next is CrowdStrike, which has been growing its revenues at a 30% year over year in every single one of the latest quarters. However, it's still like this company is having difficulty with their net margins and profitability. 2 quarters ago, their net margin was around 5%, which is okay for a growth company. However, in the latest quarter, it was actually negative 2%. And just because of that, I will place this stock as a B tier. I know I'm very picky, but hey, we're talking about growth stocks. If these don't play out and they don't beat market expectations, the drop in stock prices are always massive. Next, we have DDOG, which is extremely predictable, and the revenues have been growing at close to 25% year over year for the past quarters. Additionally, they have been consistent with their margins, which have been trading somewhere between 6 and 10% for the past 4 quarters, and that to me is a very positive sign, which will place it on an A tier. Next, we have Duolingo, which is a very underrated stock, and this stock has been growing its revenues by 40% year over year in the past quarters. Additionally, their margins are excellent and they have been improving quarter after quarter, currently sitting at 12%. I'm sorry, but to me, this is as close to an S tier as you can actually get your stock to. Next on the list, we have e.l.f. Beauty. Now, this company had been growing its revenues at an 80-70% year over year in the past. However, now it's actually growing its revenues at a 40% year over year. It's not bad. However, its latest revenues are actually lower than the quarter before it. The margins of this company are all over the place, so just because of that, this company will also go into the C tier. Next on the list is Shift4 Payments, which is a company I actually did not know until you asked me to include this company in this video, but it looks like it's a company that provides payment processing in the US, and it's doing the right things. This company is trading at a PE ratio of around 58 times, which is a lot lower than all the other companies in this list, but its revenues are still growing at a 30% year over year for the past quarters at an extremely sustainable pace. The one thing that I'm not too happy about it is that its margins are very slim, currently at a 6% net margin. However, this margin has been expanding every single quarter since quarter 4 of 2023. I will have to do a deeper dive on this stock, but to me, it currently goes at A tier. Next, we have Grab Holdings, which is just on the limit of being a growth stock, growing its revenues at a 16% year over year, and this growth rate has been decreasing quarter after quarter. The thing that I don't like about this company is that its margins are all over the place, and most quarters they haven't been positive. So this will go into C tier as well. Next, we have Hims & Hers, and this company is like a rocket. Its growth rate year over year for the past quarter was a 77%. And this has been going on for all the other past quarters, with its growth rate never going under 40%. Additionally, the average of their margin is around 4%, which had been increasing quarter after quarter as well. So I believe that this is a great company, and I'll put it in an A tier because its stock price in the past year has risen over 210%, and I believe that it has a lot of risk on the uncertainty side. Another company also up over 200% in the past year is Robinhood, and this company is trading at a P ratio of around 70 times, which, when we see its growth rate of around 37% year over year, it kind of makes sense. However, this is another case where its revenue has been growing year over year. However, its latest revenue was actually a lot lower than the quarter prior to that one. However, this company clearly makes up for this because in the past 3 quarters, it has accomplished a net margin of over 23%. I will have to place it in the B tier. Next, we have Interactive Brokers. I know this company is not such of a rocket. It trades at a P ratio of 28 times, and its revenues are growing at a 17% year over year. However, the only thing is that its revenue growth rate is actually decreasing quarter after quarter. I will have to place it as a high C, especially again because it seems like it's already a mature company, but it only has margins of 7%, while Robinhood has margins of 23%, and they're in the same industry. Next, we have Lantheus Holdings, and full disclosure, I own this company, and it's currently trading at a 15 times earnings. Now, this company has been growing its revenues at an 18% year-over-year growth, and even faster when we look at prior quarters. Of course, this means that its revenue growth is decreasing. However, since this company has such astonishing margins, I think that it more than makes up for it. In the latest quarter, it had a net margin of 35%. And this doesn't seem like a one-off item, because in the past year, it has only had one quarter where its net margin was under 29%. I will not put this in the S tier because it's not a hyper growth firm. However, since it's so predictable and it has such great margins, I will have to place this at an A tier. Next is MongoDB, which has been having a horrible year and its stock price is down 42%. In the past quarter, their revenue growth rate was at 22% year over year, but the thing about this company is that it still is not profitable. I will have to place this between B and C. I will place it here. Next, we have Mercado Libre, which is a monster. It has grown its revenues at a 41% year-over-year growth rate, and it has solid margins which have stayed between 7 and 11% for the past 3 quarters. Additionally, this company's growth rate does not actually seem to be slowing down. In some quarters, it actually looks to be accelerating, so I will have to place this as an A tier. Next, we have Nu Holdings, which is a hyper-growth company which trades at a 28 times earnings. This company has grown its revenues at a 39% year-over-year. This is a much slower growth rate than in the past when it was achieving 80% and 90% growth rates, and this was still in 2024. However, this company looks like a much mature firm and it has been achieving net margins of between 15% and 22% for the past years. Given this valuation, I do believe that there is an opportunity with Nu Holdings, and I will be doing a deeper dive on this company. I will place it as a B tier. Next, we have NVIDIA, and I don't think there's much to say about this one. It goes straight to the S tier and even in front of Duolingo. This is one of the companies with the highest net margins you can find and with the highest growth rates you can find, which is why it has become the world's most valuable company, and it's why it's the best growth stock you can actually have. Next, we have Palantir, a stock whose price has risen over 350% in 2024. However, its revenues are growing by 30% year over year. It's a very high growth rate, but does that growth rate justify that huge increase in price? Well, it's not only that, it's its growth in profitability and its net margin expansion. Next, we have Shopify, which is a company which has grown its revenues at a 29% year over year in the past quarter. When we look at its growth rate, a year ago, it was actually negative. So this company is not predictable at all. I think I will actually place this as Wall Street bets. I don't think it should be an avoid, but I think that the predictability and the growth rate factor is just not there. Now we have Snowflake. Has been growing at a 28% year-over-year growth rate for a very long time. However, it's still not profitable. It hasn't ever been profitable, and the only thing that's happening is that its net margin is becoming more and more negative, so it's losing more and more money. Next, we have SOFI Technologies, which has been growing its revenues fairly consistent at a 30% year-over-year. However, this company does not have solid margins, and I will put it at between B and C tier, mainly because I don't like the amount of shares that they're actually issuing year after year. Now, what is there to say about Uber? This company has grown its revenues at a 20% growth rate year over year, and in the latest quarter, they showed everyone that they can be very, very profitable, throwing in a 23% net margin. Since this is not growing at a 50% rate, I don't think I can put this in the S tier, but it for sure goes into the A tier. Next, we have Zscaler, which has been growing their revenues at a 26% year-over-year growth rate, but they're still having a lot of issues with their margins. They have still not managed to become profitable, and they're a company that is valued at $30 billion. Now we have DoorDash, which has been growing its revenues by a 25% year-over-year growth rate, and last quarter was the first time it was actually profitable. So I will put this as a B tier. Next, we have Google. Now, disclaimer, I do own this company, but I was not planning on including it in the video. You suggested it. I didn't think it would be classified as a growth stock, but it has actually been growing its revenues at a faster rate than 15% year after year for the past years. Now, I think there are very few companies that can actually compete with Google, and due to its 30% net margin, I will classify this stock as an S tier. Next, we have AppLovin, which is a company I did not know about, and it's up over 700% in the past year. It's a 112 billion market cap company, but the fact is that its revenue has grown at a 39% year over year. Does this make a 700% price increase reasonable? No. But when you pair this revenue growth rate with its net margin expansion, it starts to make a lot more sense. This company has gone from a 12% net margin to a 36% net margin in 1 year. So I would place this company as an S tier, but the fact that it has grown so much makes me place it one step lower into the A tier. Next we have ON Holdings, which is trading at a 130 times earnings. This company has grown its revenues at a 35% year over year, currently has a net margin of around 4 to 6%, but since this is in the clothing industry, I'm not sure how much we can trust the sustainability of the growth of this company. Despite that, since it's so solid, I will put it as a B tier. And last but not least, we have The Trade Desk, which is trading at a 200 times earnings and is able to grow their revenues at a 27% year over year. Currently, it came in at a net margin of 15%. So this looks like a very solid company, very predictable. This will easily go into the A tier. So anyways, if you stuck until the end of the video, thank you for watching. As always, this has been the Cashflow Compounder, and I'll see you in the next one.